Yield versus capital growth, probably the number one question we get asked on a daily basis. Are they linked? Do I have to sacrifice one for the other, etc., etc.? Firstly, I want to get into yield. So yield, if you're not familiar with yield, yield is the rental yield or the percentage of value of the property and the rental income that it provides. So if you're completely new to property investing, if you've got a $100,000 property and it's yielding 5%, it's bringing you in $5,000 of rental income per annum. If you're getting a 2% yield, you're only getting $2,000. And to give you some examples of locations, you might be getting a 5 or a 6% yield in Perth. You might be getting 2 or 3% rental yield in somewhere like Sydney or Melbourne, and that obviously means you're getting essentially less rental income versus the value of the property. But to get into the yield side of things, so understanding what drives yield. So yield, there's a few factors in there. So firstly, there's location. And what you will typically see in terms of on the yield front is the further you out you go from the city, is you typically start to get higher yield points. And you might ask, why is that? Well, there's a few reasons on that. First one is to do with supply. So as you start to work your way into a more metro or dense area, you typically, let's just use, again, probably Melbourne, Sydney, Brisbane are good examples of this. If you're in the CBD of those locations, what do you see in terms of what is doing most of the housing work there? The heavy lifting is really covered by high-rise apartments. So if you've got this flood of stock coming into the market, and some of these locations are pumping out hundreds, if not thousands of rental apartments in these exact buildings, that extra supply, what essentially it does, it puts a throttle on the rent you're able to achieve on the market. And it can be actually quite seasonal when the students maybe go in and out. So, investors tend to just want to be a little bit more cautious in terms of making sure that property is consistently rented. So you tend to get lesser yields as you go on based of that supply. And that's also to do with zoning as well. As you start to get more inward, your zoning starts to get more dense. All of a sudden on those construction sites, you're allowed and permitted by councils to build those high-rise apartments. But if you go out into suburbia, well, you might only be able to split your 800 square metre block into two 400 square metre subdivided lands. That's a bit of a tongue twister, where sometimes you can't. Sometimes you're not able to subdivide it at all, depending on the zoning laws there. So the reason you'll start to see those yields fluctuate is that density, that supply, but also it's to do with the ability to turn a profit on development. So what I mean by that is, if you're a developer and you're moving into somewhere like Metro CBD of Melbourne, Metro CBD of Sydney, you're going to be able to punch out 100, 200, 300, 400, 500 apartments on a site and be able to develop and turn a profit on those apartments. Where if you're a builder out in the suburbs, firstly, a lot of them will not have the labour force to punch out 100 to 200 homes out in the suburbs, which is what it's going to take to get a similar impact in terms of the supply level. So that's number one. Getting access to the raw materials from a building standpoint is number two. So that oversupply is harder to achieve. And then it also comes down to disposable income. So understanding how that impacts yield as well. So if we look at the two highest priced dollar figures, so not talking about yield points, but dollar figures for rents across the country. One sitting in Sydney, undoubted, that's a very expensive part of the country to live in from a rent perspective. And number two, you're getting closer to that being Perth. And coincidentally, or not so coincidentally, those two cities have the highest disposable income in the country. So, that disposable income means you're able to pass that and cover your rents. So you see that in the Sydney market, you're seeing that now in the Perth market. It's always kind of historically been in the Perth market. You see that in mining towns. You'll see where these pretty average looking homes are going for $600, $700, $800, $900 a week. Because why? Because those employees have high disposable income and they're happy to put that into their rent. So that's where your yield comes into play. Then we get into capital growth. So understanding what drives capital growth. Yield has absolutely zero to do with it. Where you could potentially make the argument that yield has an impact is when rents get to a certain level that it turns renters into home buyers in an area. But that is not necessarily the biggest driver. It all comes down to three main factors. So firstly is demand. Is demand in the area very strong? If you don't have much demand, well, you're not going to see much capital growth. The second one is supply. Is there a surplus of supply, or is there a shortfall of supply coming into an area? If demand is outstripping supply, that means there's scarcity. That means it's a hotly sought after commodity, and that's typically going to push capital growth. And the third one that impacts it is confidence. So you've got to have confidence in a market. Sydney's been a really, really solid indicator of this, probably over the last 12 to 18 months. Saw interest rates go through the roof over that 18-month period from they've been at the very bottom. So what happened? The confidence in the Sydney market fell to the floor. More expensive price points are more volatile. Where are the most expensive price points? They happen to be in Sydney. So your multi-million dollar suburbs in Sydney went through the floor, some of them correcting as much as 10, 15%. Confidence comes back into the market. Supply and demand was already there, but confidence wasn't. They've now started to pick up and they're growing at a very, very good rate. They're now above the COVID highs that we've seen previously. So capital growth and yield are two separate items when you're assessing a property, and they are not really linked whatsoever. However, you then might ask, well, if yield and capital growth aren't associated at all, why doesn't everybody just go out and get a 5 or 6% rental yielding property? And why are some people buying negatively gearing and buying 3 or 4% properties? So to answer that question, that is mostly driven by, the demand from investors. Some people, not everybody's comfortable with borderless investing or investing in regional towns or areas that they're not familiar with, areas that they're not able to touch and feel. So you're going to get some people, and we deal with them on a daily basis, where they are rusted on, loyal to Sydney, and all they will ever do is purchase property in Sydney. They're completely fine with negative gearing, and they're completely fine with being out of pocket and, getting their money back come tax time. They just want to continue to pour their money into the Sydney market. They can touch and feel it. That's no doubt for them. And then you'll get some people who, probably like myself, a little bit robotic and process driven, where for us, it's just about, does the dollars stack up and does the data stack up? And I'll go and invest my money anywhere and everywhere as long as the risk factors are low and as long as the returns are going to be high and it's not hurting my hip pocket too much to hold and maintain that asset. So I hope that answered most of your questions that we get on this topic. Again, it's going to come down to personal preference. So when we deal with a client, we will ask these questions. Do you have a preference from a metro to a regional location, for example? And if they turn around and go, yes, I only want to look at a metro location, well, that will mean that we're going to be, sometimes the price point's already determined for us. That means, we're going to need to be at least, in most instances, $500,000 to $800,000 price point to get into a metro market. And the rental yields will be typically less than we can get into regional or outer fringe suburbs. So it's really more understanding what type of investor you are, because the last thing you want to do is go out and purchase property that you're not comfortable with. If at night you sleep way better knowing that your property's in a metro location and you're comfortable with that and that makes sense to you, fantastic, go for it, but understanding there are some sacrifices along the way. In terms of capital growth, there is absolutely no evidence out there that being in a metro or a regional location is better or worse. They go through different cycles. Sometimes they're linked, sometimes they're not. The performance has been pretty similar. In fact, I think regional in the last 35 years is still slightly ahead. It's always depending on what segment of timeline you want to compare them to each other. But in general, they're not correlated at all. It does come down to personal preference. Guys, I hope you found today's topic insightful. If you've got any more questions, please leave a comment below. And if you're not already, please make sure to follow me on LinkedIn, where I'll be posting more reports and data-driven insights on that location. For now, catch you on the next one, and bye for now.